Hello everyone, today is Friday, December 9th, 2022. My name is Evan. Welcome back to another edition of Stock Market Weekly, where we break down the most important trends, price action, and noteworthy moves across financial markets. And we do that by breaking up our analysis into two parts. So in part one here, we comb through the numbers and pick apart everything that stands out, looks a little bit different, interesting, or notable. And then in part two, we jump into the charts. We take a detailed close look at price action and measure and map those longer term market trends, all to best position ourselves looking ahead. So hopefully that sounds good to you. Let's jump into some of the takeaways, some of the action talking points from this week and what we're going to discuss in this week's video. Equity markets threatening to roll over. So this is point number one here. And remember, we came off of a pretty rosy past 2 months in equity land and frankly, bond land as well. It's been a good rise here, good counter trend to the longer term trend action that we've seen over the past 6 to 8 weeks. And we finally see a little bit of turbulence this week. And if you recall, the title of our video last week, so our Friday SMW video, was called Regime Change or the Best Short Selling Opportunity that we've seen all year long. And 1 week later, it looks like the bears are certainly winning that debate or that argument or the way to view the market last week. And we sort of laid out both the kind of bull and bear cases. And that's 5 days later, we're down 3% and things are looking pretty dicey here for the bull case. We're going to talk about why maybe the bears don't want to get too ahead of themselves, but they certainly put in a good convincing week here. We had oil also putting in a weekly bearish engulfing bar. We saw the bond market rally stall out right alongside of equities. So let's get into it here. By the numbers, if we look at the right-hand column, every single of the major U.S. indices here were in the red this week, about 3%. Look at world stocks minus the United States, so you can still see some relative outperformance going on there. Notice 1 month performance still green as well for the ACWX index. So we're still getting a little bit of overseas relative strength. Now, if we take a look at these trends here, we've got an interesting look. This is a look we haven't seen in quite some time. We still have the 200 SMA, which is declining. So that is our very long-term measure of trend, and that no change. Pretty much been that way all year long. But as we've talked about in the recent weeks, we're starting to get the 50 SMA rising across the board. And if you recall, it's the 2 month rally that we've basically seen in equity markets have done enough work to the upside to turn this up. But now with this week's weakness, we are seeing the 10 SMA start to decline here in the US averages. So we've got this interesting sort of sandwich effect here where it's really just pointing to the message of the market here, which is time frame certainly matters, but beyond that, still, there is lots of conflicting evidence, and there are good cases to be made on both sides of this market as really stocks markets are figuring out direction and, kind of the path that they want to take going into the year end here. And this is really a nice depiction of the confusion that's going on right now across these different time frames. Now, if we take a look at the volatility environment, all good things must come to an end. We had briefly a VIX that was under 20. Well, we're back over 20. We rose across the board here in our volatility indices, VIX, Nasdaq VIX, or Nasdaq Vol, and the Russell 2000, all pushing up about 2 to 3 points this week into the low to mid 20s. Now, market breadth here, 52-week highs and lows, we track this every single week, and it was a pretty disappointing week once again for market internals. I know there are some folks that are getting excited that, number of highs, in the NYSE or in the stock market just generally here have been on the rise, and certainly a true statement, but it's still not that exciting to me as someone who looks at these numbers very closely for years, frankly. I tend not to get too excited until we start to see at least, again, the number of highs per day over 100. That to me is starting to get a little bit more of a convincing kind of breath thrust, if you want to use that term, or at least some broad market buying. And we're still not quite seeing that yet. And in fact, we got more new lows this week than we did highs. Not totally surprising given the fact indices were down 3%, but this is still a ratio we are waiting to improve to get more and more excited on the upside for this market. Now, this was a tweet that Liz Ann Saunders put out. So her handle is right here at Liz Ann Saunders. She's a great follow on Twitter if you don't follow her. But I thought this was interesting about the Dow Jones versus the S&P 500, the relative outperformance, one of the strongest that we've seen really going back to the 1950s, at least this data goes, and showing just the relative strength out of the Dow. And last week, again, we talked about, a regime change here that's taking place, and, whether or not it's a regime change to a bull market, it could certainly be a regime change to different leadership, different market participation, and this chart certainly illustrates it. So certainly going to be an interesting new year come 2023 if this trend does continue. Now, if we make our way over to sector performance this week, every single sector closed in the red. No strong, no good leadership this week. In fact, you saw basically the worst lineup here where you had defensive areas of the market, utilities, healthcare, consumer staples. They were the relative outperformers here. So they were at the top of the stack. And on the downside, we had energy really getting slammed hard here, 8.5%. That's a big week down for energy. Of course, it's been a strong performer year to date or in the past year. Take a look here, 51% blows away basically the returns of everything else combined and then some. So some strong energy outperformance this year, but certainly over the past month or so, it has been the laggard. And oil, of course, this week was down pretty convincingly in the red as well, which certainly helping that case to the downside. Communication services down 4.81%, and consumer discretionary to round out the bottom three. Now, in terms of IBD industry ranks, so they are Investors Business Daily here is a sponsor of our show, so thank you for that, Investors Business Daily. Check them out with the link right here. So they go a little bit deeper. They track industry rankings, and you can see that it is still got some oil and energy in here, but it is phasing out. So this list was dominated by energy over the past many months, frankly. But now you can see we've got more and more computer networking. We've got food, dairy products. We've got education. We've got machinery in here. We've got retail. So the energy is actually slowly being phased out, and there's no surprise there given the underperformance recently. And we're starting to get some new industry ranks in here. So certainly check this link out if you want to get access to this data table, which updates every single week. Every single day. And we only track the top 10 here that we include, but certainly you can go pretty deep on what's working and what's not. Now, 10-day correlations, we can see a couple of things that are notable here. First is the dollar, I would say, is notable because this is probably the weakest correlation to what the dollar is doing and what stocks are doing that we've seen pretty much all year long. Now, I want to remind everyone once again that these are 10-day correlations we're looking at. So these are inherently short-term and noisy. So these do flip around quite a bit. But I would still say that, the dollar drop here in terms of correlation for stocks is notable, and we'll see how long that can last. The dollar's been weak, and the stocks have, certainly been weak this week. So we'll continue to pay attention to that. TLT, TNX. So these are basically our bond and then interest rates here on the 10-year, and you can see those correlations are dropping as well. So this is, in my mind, a good thing when you start to see these correlations break down a little bit. Not everything should be moving in a risk on, risk off fashion in healthy markets. So when you start to get some discernment here between asset classes and individual indices, that tends to be, a good thing. So notable, but we'll see how long it can last. Now, if we take a look at Treasury yields, they were up across the week here. So again, we were, talking about how exciting it was to see 10-year yield below 4%, then below 4.8, then below 4%, then below 3.8%, then below 3.6%. Last week it was at 3.5%, and then finally we're starting to see it uptick just a smidge here, up to about 3.56% in the 10-year yield. So again, it's been a heck of a run here. Interest rates have come off their highs quite significantly. So again, we'll see if this can continue, and if this is just a temporary kind of consolidation after a good run, or if we're going to see something more meaningful here. Obviously, this is going to be an important lever to what the stock market's doing, and certainly has been driving a lot of the flows and narrative this year. So last but not least here, if we take a look at dollar and commodities, so the silver was at the top of the list here and really putting in a strong run. So this is, I believe, closed above its weekly Bollinger Band, if I'm not mistaken. So it's had a nice move here. It's up 8% across the past month. So definitely showing some good strength there. Natural gas ended up this week after really getting hit hard recently. Dollar index was up. And everything else here in terms of commodities, so copper, gold, Bitcoin, all down, but just slightly. They're basically flat on the week. Same thing, agriculture was down just a bit, and crude oil was the big loser. So 10% to the downside. It's a big week for crude oil to the downside, and starting to break some longer-term technical levels as it moves negative on the year. So that is all of the movement there by the numbers. If we take a look at our two quantitative trading systems here and how they're handling the market, we're starting to get a little more of an increase in buying in our short-term system. Lamerick here up in its exposure now almost 33% to the long side of this market. It has been really kind of playing things from the short side or been very defensive, and we're finally starting to see a little bit of an uptick in buying recently late this week. So we'll see if this continues as a trend into next week, but that notable uptick in exposure, but still holding, mostly cash. And then our longer term system here, Merlin, is still, got 1 foot, almost 2 feet outside the door here, just kind of hanging out, not really getting too aggressive on this market, still waiting to see if buyers are really going to convincingly sort of step in and support this market. So we've got a lot more information on our website. Take a trial if you're interested. Start the new year with some rules-based systems that manage risk. They focus on managing risk. We're not trying to double, triple our money in a year at the expense of crazy volatility. Is meant to be a portfolio that can really handle sort of changing market conditions and outperform sort of the drawdowns of buy and hold portfolios. So that is it for part one. We'll be back here in just a second with some charts. All right, here we go. We've got TC 2000 open. We're looking at the S&P 500, and this is a weekly time frame. This is where I want to just start real quick to get a pulse of what has gone on here over the past 4 weeks. And quite frankly, you can see absolutely nothing has gone on in the past 4 weeks. It was basically a lot of chop, and certainly time frame matters here. So if you're staring at markets every single day and you're trying to get range and moves and swing trading in a very shorter compressed time frame, then this has felt difficult given the fact that we have gone nowhere. But when we kind of just step back and frame out the price action, really we see a market that has traded between 39.30, let's call it, all the way up to almost 4,100, which is about a 3% range, and has basically just been violently kind of swinging back and forth in this range over the past month. And preceding that was this big kind of igniting candle to the upside here, which was the Thanksgiving week here, the week before Thanksgiving in the U.S. Holiday. We saw the S&P 500 up 6% as it took out new kind of multi-month highs here. And since that time, we have seen now basically consolidation take place. And so the way we've been framing out this market, let me switch to this grid here, is these, kind of clear but wide bands of horizontal support resistance, or just really inflection points for markets. And so our point of view has been 3,900 a key area for the market as really being the big line in the sand. And the fact is when we broke above it back here in late November, our idea of kind of a next target was to come in here and fill this gap up around 4,100. And so basically last week on our Friday video, I expressed sort of my lack of maybe enthusiasm up here now that we had hit some of our objective, that it wouldn't be surprising to see the market kind of just cool off a little bit, or, that fervor to just sort of dial back a little bit. And we obviously posed the question of, is this it? Is this the great short selling opportunity into this gap fill, into this prior overhead supply zone? And is this a great spot to put on some shorts for the next rollover leg down in this big bear market that we've been in? And of course, 1 week later, yes, it seems to be the latter, in the sense of it was good to sell into this and good to put on shorts if you did that. But now that we're back down towards the low end of this range, we are now, kind of hovering near support. So this is where, if you're shorting up here, it's like, okay, well, maybe now it's time to take some off the table and see how the market handles this 3,900 zone. Because, when I take a step back and again, I look at that weekly chart, I sense that we've gone nowhere. We've worked off this big move from late November. We still have this big open gap in play here and really sort of driving the action. So to me, I'm going to stay pretty steadfast on the outlook here. If we're over 3,900, I still want to remain optimistic in this market. As lousy as it does look in the very short term here, we basically have seen 6 out of the last 7 days of selling, or 7 out of the last 8 days have basically been down. So it has been very gloomy here over the past week, and we certainly lost the upside momentum from the session on November the 30th. So that is clearly out of the market now. And if you're a short-term trader, I do think we talked about perhaps using Wednesday's lows as a momentum line in the sand here, up around 39.40 or so. So if you're out of the market, if you're stepping aside here, I get it. Look, it's a tough, difficult, choppy zone. But when we step back here, I still want to kind of hang my hat against this 3,900 zone and use that to measure and manage risk against in terms of long exposure. And so that's kind of the way I'm still looking at things going ahead. If we get a follow through week here, if we just come in with the same amount of energy to the downside next week, and we put in a big follow through week lower, I'd say that would be really ugly for the market, and that would be setting us up for a pretty painful end of the year. Breaking this convincingly, this kind of uptrend that's been in place, breaking through this support area here, and potentially setting us up for another leg down is certainly what I would expect if we get a weekly close underneath 3,900. So we're gonna take it one day at a time. We're a little bit kind of oversold, or got some pessimism in here. I know we've got more data coming out next week in terms of macro data and Fed speak and all that fun stuff. So it'll be interesting to see, next week and how the market gets through it. But certainly right now, we're in this very choppy zone and directionless for the past month. So I think now more than ever, we need to keep an open mind here. I think lots of traders are, getting pretty stuck in their lane of their opinion of either, market has bottomed and we're going higher, or folks that are thinking, well, it's nothing but down from here. We just put in a big bear market rally and we're going to go to the next leg lower. And, obviously, one of those will ultimately be proven right, but there could be a lot of chop and zigging and zagging in between that. So we do want to just keep an open mind and understand kind of the time frame strategy process that you have in front of you. So anyway, that's a long-winded way of saying lots of chop, holding above 3,900. Let's keep an open mind and see which way we can move next week. Now, same thing for the Nasdaq 100. We have been looking at this band right in here, and it is a wide band, right? But we've basically been using the October highs, November highs here, Market's been digesting right at this zone here. This open gap is still up. So look at all of this just sideways pent up energy. Everyone in here over the past month is basically frustrated or getting whipsawed, and there is going to be a breakout from this range. Direction is still TBD, but if we start getting a meaningfully significant close below 279 or so, then I start to begin pretty pessimistic here in the Nasdaq 100. If we start to roll over, lose this range, and come back down here and fill this gap, that would be, again, just like we talked about in the S&P 500 bearish scenario, that would be the bear outcome here. So let's keep an open mind. Lots of fuel in the tank right now. Let's see if buyers come in and support the low end of this range again, or if we do in fact kind of roll over and start breaking down. I will certainly be acting accordingly if that is the case. The Russell 2000. So the Russell 2000 here probably looks the worst out of all of these. You can see that it is really kind of losing the past multi-week lows right now. You can see that the volume, performance this week was down 5%. So one of the largest weekly losses here of the major indices. And so things are looking a little bit bleak and heavy here, and have already pretty much filled the gap back here from the November the 10th session. So it is certainly got a different little pattern look developing here in the Russell 2000, but it's certainly the most bearish out of all of the major indices. You can see volume has been, generally speaking, pretty light. If we look at the Qs here for this week, again, everything was below average volume here, and this is, again, last point I'll make on volume, I think we used the S&P, but you can use the Nasdaq as well, is all of the heaviest volume days have been on the upside for this market. It tends to be a market that is, thrusting higher on some significant volume, and then it just takes its time consolidating and setting up for the next big the big volume move, which has been to the upside. That has been the pattern over the past 2 months. So let's see if that again changes into next week. So that is price action there that I'm going to be paying attention to in terms of major indices. Let's run through a couple of other markets here. Commodities first. Gold was basically flat this week. Good range in gold, but it held in there. It managed to close pretty much flat after some real strong performance. Last week was up 2.5%, and certainly over the past 5-6 trading weeks, it's up about 10% off of the lows. So certainly has a lot more life in it. Volume hasn't been all that impressive, but price action is still working higher. Silver has been probably more impressive. Again, volume hasn't been super exciting here, but silver in just a couple of months' time is up about 29% or so. It managed to actually stay green this week. It had a large range as well, but it is coming back into these 2021 levels now. It is starting to reclaim the $20 lows here from 2021, and this is again, increasingly looking a lot better here, both rising kind of from the ashes and performing pretty strongly. Now, if we take that in contrast with oil, you can see oil here looks a little bit different. We've got a bearish engulfing weekly bar, and we've got it on heavy volume. This is quite pessimistic here. Now, admittedly, I have been buying a little bit of USO here at these prices, basically, and I'm just trying to feel out right now if these lows can hold around 62, which is approximately the September lows. You can see there's a slight positive momentum divergence here out of the MACD, but I do dislike this weekly bearish engulfing bar. So I don't want to be a hero, and I don't want to have a extreme large position, but I am recognizing the fact that we are pretty much down in a straight line over the past 6 trading sessions, 13%. We're back to some prior levels here, and I'm willing to, establish a little bit of a position in the 63 area is when I think I started buying, or so. Maybe it was 64 down to 63, but I've just got that feeler on. We're going to see if I can, build a position here. That is the idea, but I'm willing to throw this away and scratch a partial position if this can't get its act together. Technically, of course, looking pretty bleak on this weekly chart, but we'll see mostly, kind of sideways and grinding lower here over the past many months. So that's oil. That's the metals. If we look at bond market, you can see IEF here here with this weekly kind of turnaround candle, rejected from highs. I mean, it's had a great run off of these lows here from November. It's up about 6% in the IEF, which is around the mid duration 10-year, 7 to 10-year bond funds. So this is, kind of par for the course. Daily chart here still hasn't really broken trend or done anything too extreme, kind of checking back, and we'll see if it can hold. Same thing with TLT. This Friday session was maybe a little more bearish here, but still, objectively holding up in this trajectory that it's been over the past 6 or so weeks. So let's keep a pulse on it as we go into the middle of December. So that, I think, is pretty much everything I wanted to talk about. Again, message of this week, I think, is, zoom out a little bit and, keep an eye on, the lack of direction over the past 4 weeks now, and just keep an open mind. There's lots of strong, loud commentary on both sides of this market. And I just think it's a really challenging, murky outlook here over the next 1 to 3 months. So I think you really just need to keep an open mind, manage risk, and manage risk. So that is it for me. Thanks as always for tuning in every Friday, long form market analysis just like this. If you've got some thoughts of your own, I'd love to hear them below. Share what you're looking at this weekend. Do you have an opinion? Was that the top we just saw this week? And are we about to start that next leg lower? Give me your facts. Tell me why you think that may or may not be the case. Love to read what everybody's looking at. So thanks again and have a great weekend.